What's up, guys? It's Titus. I'm back with another video, and today we'll be talking about index funds, and we're going more in depth. We're talking about the different types of bonds and index funds. So before we get started, if you haven't seen my last video about what an index fund is, go check it out. I'll tell you step by step what an index fund is. In this video, we'll be talking about the bonds that are included in those index funds. First, if you don't know what a bond is, it's basically like a business that you loan money to, and then they have to pay you a dividend back. So that's pretty much what a bond is. Here's the first type of bond we'll be talking about today. We'll be talking about the broad market bond. A broad market index tries to capture a large swath of an investable market that can apply to stocks, bonds, or any other type of security. Broad market index funds typically have some of the lowest expense ratios. Additionally, asset turnover is extremely low in broad index funds, and they're extremely tax efficient as a result. So it's basically saying you make less, and then when you close out on your wins or making money, you don't have to pay that many taxes. In case you're hoping to get most of different crate stocks or securities in one go, a wide market file store is for you. No, nothing less or nonetheless that in the event that you invented to put resources into other file reserves, you face some cover with your property and your wealth in your wide market record store. So here's some examples of broad market index funds. We have Vanguard Total Stock, NASDAQ Mutual Fund, BTSMX, and then the other ones around here: Schwab Total Stock Market Index Fund, NASDAQ Mutual Fund, SWTSX. And remember, guys, this is not financial advice. This is for educational purposes only. Yeah. I'll leave the link to this presentation in the bottom of the description, so you guys can check it out for yourself and you want to learn a little bit more about it. Take another look at it to make sure you know everything. So the next type of bond, the international bond. So international bond is basically you're investing in bonds that are outside of the US. So China, Japan, like those type of bonds. France, Europe. If you want to add something outside exposure, international index funds can provide it for you. Many broad market index funds focus specifically on US markets, but there are a whole lot of companies in the rest of North America, South America, Europe, Asia, etc. International index funds aren't necessarily grouped by geographic bounds like Western or the Middle East. You can buy funds that track indexes in emerging markets or frontier markets which aren't tied to specific geographic region. So to simplify that, that's like something. So if they have a factory in China and a factory in Germany, or if you want to invest in any of those companies, you can invest in something in China and then something in Japan, but it's not going to be under China. It's going to say it has that included into the bond or the index fund. So it's going to be all in one, but you're still going to be investing in those two. So it's not bound to it's a China stock, or it's not bound to it's a Japanese stock. They're all put together, so it's not a specific stock or index fund. Examples: Vanguard, FTSE, etc. NASDAQ Mutual Fund, VF Wax. The next one is market capitalization. Most bond market index funds are rated by market capitalization, which could leave you with little exposure to small and mid-cap companies. Smaller companies historically outperform larger companies over the long run, but with a greater volatility. The reason why the smaller companies usually outperform the larger companies is because the larger companies have already done their growth. They have already majority of their growth. They not that they're done growing, they just grown a lot already. So the smaller companies have more of a chance to grow and have that big sprout. Like Bitcoin, for example, back in 2015, worth 200 or maybe $1. I don't remember exactly, but it was very cheap. And now today it's worth $60,000 for one Bitcoin. Crazy. So like it's very easy. Like I said, because it's a lot easier to grow earnings or sell a small business based off things off of billions dollars. I said risk is smaller, less well established company following is greater. Investors with a long-term horizon could benefit from great exposure to broad market. So example, CCIV, if you guys know what that stock is, or Lucid Motors, I have invested in that myself. It is the company's been around since, I want to say it was 2009, 2007. The only problem they had getting their car out is they didn't have any funding for the business, and they were very cheap. I think they were at $9 at some point. Now they're at 30. I invested around 20. Yeah, CCIV is still growing too. It hasn't even released a car, and it's doing pretty well in the stock market. So that's an example of that. Don't invest in like Tesla. I mean, you can if you want to, but you shouldn't, because it's already done its growth, the major growth. Here are the examples. Term-based bonds. For fixed income investors, bonds terms can play an important part of their asset allocation. Managing a good mix of short-term, intermediate, and long-term bond maturities can provide stable bond income for years to come. Using bond index funds makes the task simple. So long-term bonds can provide relatively strong returns while interest rates fall, and short-term bonds can provide more stable returns. Intermediate term bonds fall in the middle. So term-based bonds is like, for example, I invest in FCOM. It's a communication system. They work with communications. They have Verizon and different type of communication companies all in that one bond. And it was a cheap bond when I invested into it. It was around, I want to say 30. I don't remember exactly. It might have been 20 something, but now it's at 50. It's just growth. It grow, and then they pay dividends every time. Examples: Vanguard, Nasdaq Mutual Fund, VB Lax, and municipal bonds. Investors seeking tax-free income from bonds will find municipal bonds attractive, but buying individual issues is time-consuming and risky. So a municipal bond index fund will keep risk and taxes at bay. So you won't have your risk tolerance, you won't have to worry about that really. And then the tax, you don't have that much of the tax on it. Municipal bonds are exempt from federal income tax, and they are often exempt from state and local tax when an investor resides in the same state where the bond is issued. That's pretty nice. So if you reside in the same state where that bond is held, or wherever they, yeah, the bond is issued, and you tax free. Exempt from federal income tax. Exempt from state and local tax when an investor resides in the same state. Investors living in states with no income tax can invest in national municipal bonds, but investors living in states with high local income taxes might look for funds that track indexes with municipal bonds in their own state. So for these bonds, you want to try to get these bonds in your own state. If you live in a state that has a local tax, you're going to get taxed. If you live in a state that doesn't, you're not. And here are some examples. And this is the first part of the presentation. I'm going to do part 2 for the next video. I hope you guys like the video. And hopefully you guys could hear me this time, because I noticed on my other videos I couldn't really hear myself. I don't know if it's just me. Let me know down in the comments if the mic sounds better this time, if you guys can hear me better. But I hope you guys like the video. Make sure you like, comment, and subscribe. And be in tune for part 2.